Hello and welcome to yet another episode of Voices of Vayana. I am your host Akshaya Shankar, and today we have with us André Casterman, ITFA board member and chair of the FinTech committee. With over 24 years of experience at Swift and a track record of pioneering innovations in trade finance, André is a true industry veteran. Thank you so much, André, for joining us today to share your insights. Let's get started. To start off, we often hear that B2B trade credit is undergoing a quiet revolution. From your vantage point, what's fundamentally changing in how trade credit is being defined and delivered today?
Hello, Akshaya. Nice to be here with you. And indeed, B2B trade credit is undergoing a quiet revolution. Many things are evolving, changing, practices, laws, technologies, and this results in many innovations in B2B trade credit. And it's not just about the credit itself, but all about how we are in the end moving money between those who have the money, the lenders, and those who are in need of the money, the businesses. So there is indeed an increased importance on trade payables and receivables and the financing of those transactions. Sometimes it's coming from the buyer side, sometimes from the seller side. And it's an increased importance of those instruments in comparison to the use of documentary credits and documentary guarantees that we have been talking about since decades, even not centuries. So this increased importance of open account, as we could name it, is definitely where we see most innovations. And in order to support this, and we'll come back on that in this episode indeed, it's all about the use of more technology to deliver more traceability, more transparency, and for lenders to know exactly what they're getting into. So it's fascinating space in terms of how indeed B2B trade credit is evolving.
Definitely, André. I think fascinating is definitely the right word for it. Moving ahead, we're also seeing a surge in new entrants, right? From B2B e-commerce and logistics platform to asset managers and SME lenders. So what is making this moment right for so many players to step in now?
Well, there are many businesses around the world who need more financing, whether they act mainly at domestic level within their country, jurisdiction, or whether they are trading at a cross-border level. They just need more working capital. And over the years, they have found out that there are different ways to increase this working capital. And one of the ways is to tap into their own trade receivables. They are expecting to get money in the short-term future from their own clients. So why not using those trade receivables as a collateral to get more working capital from lenders. So this asset class has evolved as a very attractive and tangible one because it is indeed very short-term and related to effective economic activity. So that's one evolution we have seen over the years. And the second one is the fact that we see indeed many new entrants in this business of financing trade receivables and payables, because the banks have been increasingly focusing on their core markets and major clients in order to increase profitability per client. And this is coming through as a consequence of increased cost of various regulations on the anti-money laundering side, on the due diligence side. So the cost increase of owning a client has led to a certain level of de-risking. And de-risking is one way to look at it. I prefer to name it increased focus on your core markets, your major clients, your profitable clients, which is why some businesses of smaller sizes have been indeed become underbanked and have offered an opportunity for new entrants to extend lending into this SME market. SMEs doesn't mean only the very small clients, also sizable medium-sized clients at a cross-border or domestic level who don't get enough funding from their banks and are turning to those new entrants. So we see a number of players, and as you say, some are already active in trade as B2B e-commerce platforms or sometimes logistics platforms. Sometimes they are purely non-bank lenders focusing on those underserved businesses.
Sure. So specifically, how are B2B e-commerce platforms and logistics companies embedding credit into this whole trade process? Are there any compelling use cases that you could speak about that'll signal what's ahead?
Yes, this is yet another evolution which is very interesting. And we just talked about how banks are increasingly focused on their core markets and offering an opportunity for new entrants, which we could name non-bank lenders. But then those non-bank lenders, you have two categories. Those who are already active in the trade transactions because they are effectively supporting buyers and sellers to trade, like e-commerce, B2B platforms, or sometimes there are logistics companies that are basically handling those transactions from start to finish, taking care of import regulations, export regulations, customs declarations, logistics, shipping at cross-border level. And they're handling the end-to-end transaction from a trading cycle, a logistics cycle, and have found out over the years that it might be worth serving their clients with yet an additional feature, which is financing, extending liquidity onto those transactions they have full visibility on, and helping their clients increase working capital by offering trade financing on top of their e-commerce or logistical activities. So this is quite interesting because we see that trade finance is not just a banking business anymore, as it was a few decades ago with the letter of credit, the guarantees, and the factoring practices, very traditional practices. It is now moving beyond the banking system. It is not leaving the banking system, but it is extending beyond the banking systems with those non-bank lenders who manage data only, and those non-bank lenders who are managing those transactions and adding financing on top of those transactions. So examples include indeed some big names like DP World, who is a major logistics company and have added financing to their portfolio in partnership with third-party lenders, such as banks, but also more specialized logistics companies like Dun in Europe and Tech Cargo at cross-border level, which is also extending to pre-shipment finance in some cases. So the access, the visibility to the end-to-end transaction from start to finish in terms of delivery, purchase order to delivery, is a great asset to extend financing, because indeed you know that the transaction is genuine, you know the various steps, and you know how the risk is evolving in order to extend this financing. So this is a very interesting space. It is not competing at all with the banks, but it is offering the businesses an additional option to get financing from those non-bank players.
Got it. So also just moving on a little bit, SME-focused lenders seem to be leading with a receivables, payables first approach. So what's different about their credit lens?
So here indeed, the goal is mainly for those lenders to manage the risk side. And focusing on the risk of transactions is, in my view, the first step when you have access to the transaction, because once the risk is covered in different ways, we'll come back to that, then you can indeed find the appropriate level of liquidity to extend the funding to to your clients as a SME focused lender, as you say. So the supply chain finance technique, as offered by Vayana, is of course the major one that multiple banks, non-bank lenders, platforms have been using over the years. It is a great way to ensure that the buyer agrees to pay, and the last few weeks, sometimes months of the transaction, as from the moment the buyer confirms to pay, will be financed. Now there is a supply chain finance where indeed the buyer approves payables so that the invoices can be paid early to their suppliers. But often we see that there are different ways to achieve the same result, and this is where the industry is now also rediscovering the value of negotiable instruments like the bill of exchange and the promissory note in support of this receivables payables first approach that you mentioned. And different techniques to achieve the same being able to extend liquidity before the invoice due date and extend liquidity on the back of a risk mitigation tool, and that risk mitigation tool is called irrevocable payment undertaking. It can be through a supply chain finance contractual scheme, or it can be organized also through the use of a bill of exchange or promissory note. It's a very dynamic space. And the best news for SMEs has been, over the years, has been that these supply chain finance techniques have been democratized, and Vayana is a good example of democratizing the access to supply chain finance and increased working capital for suppliers working in partnership with their buyers, because it's key indeed that the buyer approves invoices so that those invoices can be paid, and the lenders taking a risk on the buyer versus taking a risk on the suppliers. This space will continue to evolve, in particular at cross-border level, thanks to indeed the electronic versions of the bill of exchange and the promissory note.
Sure. But at the same time, the institutional investors are stepping in with capital. So how is their presence changing the liquidity equation for trade finance, especially in underserved markets?
Yes, we have talked since a long time. I remember for me it was 2011 through the International Chamber of Commerce about those institutional investors helping the banks, tapping into the trade investment class. And whilst things have evolved in this market, we have had to learn our lessons around the specific transactions that are of interest to those institutional investors. Of course, those investors consider trade finance as an attractive asset class because it is representing the real economy. It is not correlated to other asset classes, and it is highly diversified, enriched in data to be so that they can invest in the right sectors, countries, geographies, and corporate obligors. However, often the challenge is that when talking to the large banks, those assets are not generating sufficient yield for those institutional investors. So why bother about trade finance if the yield is not good enough? They have other asset classes to consider and that are often much easier to attract. So over the years, we have identified that the real winning relationship is between institutional investors and high yield transaction originators. And guess what? If you want to get more yield from trade transactions, you need to take more risks. And the risks are with SMEs. And again, in SMEs, you have also mid-caps, large mid-caps, but not investment-grade corporations. So this is where we see most of the success stories between asset managers and SME-focused lenders, where additional liquidity is brought by asset managers from capital markets into the trade originators' activities so that they can fund more transactions that are matching the yield expectations of those asset managers. So it has been a very slow start of this market over the last 15 years, but it is definitely growing because we now have found the right use case, the right segments for institutional investors to tap into, and the technology has evolved also to make this whole process highly efficient and as automated as possible, of course.
So, with this new ecosystem, of course, credit underwriting itself is also evolving. So, what are some of the new techniques players are adopting, especially those who aren't relying on, traditional credit insurance?
Yes, there are indeed. That's the possibly one of the top priorities for any lenders is to make sure they understand the risk they are and the credit risk in particular they are getting into. Whether they're going alone or in partnership with a credit insurer, or could be also a multilateral development bank, which are increasingly focusing on the SME segment. But indeed, increasingly, credit underwriting is using technology as well. Why? Because there is more data available, readily available, and data from various internal and external sources. So the first indeed is to look at the relationship between the buyer and the supplier. As I just said, for the supply chain finance example, the key is to get the buyer approval, which is a key risk mitigation. But this is about structuring the transaction to get this irrevocable payment undertaking via supply chain finance or a bill of exchange. But the second one is to look at the data available on the relationship between the buyer and the supplier. And the history of this relationship can tell you how the relationship has matured and how performant it has been. Has there been any disputes, late payments? And this is all about transaction data. This is not in the financial statements of the corporates of the businesses being funded. This is transaction data that is internal to the businesses, and this transaction data tells you so much about the risk that you're getting into. So that transaction data has to be delivered often to the lenders by businesses expecting more funding. So make sure your transaction data is organized and ready to be shared. And we can go back in time. It can be transaction data from the last decade about how you have been trading and behaving with your buyers or your suppliers, depending on the position you want to take. Now, this is internal data. And again, this data is not in the financial statements, so it's a new source of data for credit underwriters, whether they are credit insurers or lenders. Now, there are other, indeed, sources of data that are important and often external to the businesses. Like, for instance, we have different regulated registers that can tell you also about any fraud risk, credit risk that you have to consider. Example is electronic tax registries, electronic invoices, and electronic registries about transactions, like distributed ledgers, which are able to tell you whether a bill of exchange, for instance, is true, still valid today, or has been potentially fraudulent if you can't trace it back in the distributed ledger. And those are examples on the tax, invoicing, and electronic registries like public ledgers. Those are external data sources that lenders, credit insurers are increasingly using to enrich their credit underwriting techniques. So get access to the data, use this data, and make sure that you enrich your credit underwriting with those new options, because those options just increase transparency and demonstrate whether you are potentially indeed ignoring risks that will hit you sooner or later.
So, Andrew, you did mention use of data to better transparency, right? So, along the same lines, I want to understand what type of data then are proving to be most useful in credit decisions, and what challenges still remain in accessing trusted and interoperable sources.
Yes, indeed. Accessing the data is one thing. Then the second thing is, are you able to trust this data? Because indeed, data could be available, but could have been manipulated itself. So more and more, transparency is the name of the game in sourcing data, using data to feed your credit underwriting process and lending business. So more and more, we're going to use regulated registers, and different regulators are setting up those registers to indeed increase transparency. Again, electronic invoices is a major one, and it's increasingly regulated to fight tax fraud. We call it in Europe, for instance, VAT fraud. So you have seen it emerging in Latin America already 20 years ago. In Europe, this is becoming mandatory for most businesses indeed, and for government institutions. And it tells you whether an invoice is real, whether it's valid, and whether the tax has been calculated and paid in the right way. So it's from the electronic invoice, the regulators really want to fight fraud. But then the future is to rely also on public ledgers that are not necessarily regulated, but provided by some technology solutions, and that can tell you, which are acting also as registers, and which are telling you whether transactions are valid or not. Or whether the version of the instruments, like the version of the bill of exchange that you have been asked to fund, is that version still valid or not? Because maybe a few minutes ago that bill of exchange was transferred to someone else and there is a new owner. And that kind of transparency is what public distributed ledgers will offer you. So more transparency is definitely happening right now in trade with those digital options. I think the regulators have a key role to play to increase the number of registries, because the more visibility we can offer to lenders, the less risks they're going to take, and the less risks they're going to take, the more liquidity will be offered to businesses. So the partnership between the private sector creating those new technology options and the public sector being able to mandate the use of some of those options, or just allow the market to use some of those new technologies, is essential. So I'm always promoting, as we do through ITFA, this trade association, and other associations like the ICC. We are always advocating for strong public-private partnerships around those the use of those new technologies and the setup of those new registries. Now, at Vayana, there is also a major offering called Rubix, which also provides key insights around SMEs. Now, one thing is to deliver those insights. The next thing is to make sure the lenders are using them, which is why the combination of SME-focused insights through Rubix and the lending capabilities through Vayana and Vayana Trade Exchange are providing really the building blocks for businesses to increase their working capital.
So you spoke about regulators, so I'm just going to digress a little bit into legal enablers and digital recognition. So I want to understand how critical is it that digital trade instruments like electronic invoices and payment obligations gain stronger legal recognitions, and where are we on the journey towards frameworks like MLETR?
Yes. So MLETR is the UN legal innovation. It is a framework. It is a model law. ML is the model law for electronic transferable records. So what are we talking about? When we're talking about digitizing an invoice or a packing list or a contract, you are digitizing a document that is not representing a title. Whereas with MLETR, this model law suggests that countries should enable markets to digitize documents that represent a possession of something, a possession of goods on a ship, like oil being shipped from one country to the other, will be the ownership of that cargo will be represented through a bill of lading, which is one of the MLETR instruments. But it could also represent a payment obligation. If I owe you money, I can write a promissory note, or you can ask me to accept a bill of exchange so that I can recognize that I owe you money. Now, the one who owns this instrument physically on paper is the one who will get the money. So title documents represent really value, and when digitizing those, it is important to make sure that the technology recognizes the uniqueness of a particular electronic record, because if you don't want your bill of exchange to be copied, because then you have to pay multiple times the person versus one time. So recognizing the uniqueness of this instrument is important. So of course technologies have evolved to make this achievable. So this is not the challenge. Technology can do so much, but with what we're doing with MLETR is making sure that the various major jurisdictions around the world, G7 and many others, are enabling indeed the adoption of digital technologies for those title documents. So we call it aligning national laws with the UN MLETR. It is important for the market indeed to be able to digitize those bills of lading. In the logistics world, very important to increase efficiency and transparency, because those bills of lading will be used as collateral by lenders, and the more traceability again we can offer, the better for lenders to mitigate the risks of fake and fraudulent bills of lading. But also in supply chain finance, like with Vayana, promissory notes, bills of exchange are just another form of irrevocable payment undertaking that are enriching the supply chain finance capabilities of platforms like Vayana and Vayana Trade Exchange. So this is where MLETR is of direct relevance for SMEs wishing to increase working capital, because instead of asking their buyers to accept a supply chain finance program, they could say, actually, for this particular transaction, no need for a supply chain finance program. If you just, as a buyer, accept my bill of exchange, then I can get funding through Vayana or any other lender or platform to get early payments of this particular invoice. So we can really democratize even more financing of receivables and payables thanks to MLETR and electronic prom notes and electronic bills of exchange. There's a massive interest there by banks and non-bank lenders to take advantage of those instruments, because those instruments have been understood by the market since many years and are well accepted, but the only drawback is that the laws around the world require them to be on paper. But this is changing since a number of years. And like, for instance, English law allows electronic negotiable instruments since 2023. And the French law also allows, and I know the gift city in India is going the same way to enable the digitization of negotiable instruments. So we're going to have more and more countries, and there are many more. There are a dozen that already accept negotiable instruments in an electronic way. So the number of countries will continue to evolve, and this is good news for everyone.
Sure. And beyond legal reform, how are nations or industries building the infrastructure to support digital first trade? If you can just shed some light on that with examples.
Yeah, sure. For instance, also at the initiative of the UN, the United Nations, countries have been encouraged to create single windows. That means a single platform that is enabling importers to deal with the paperwork, the administration of customs declarations, when indeed trading at cross-border level. Morocco is a good example with Portnet. In Egypt, you have indeed Nafesa also acting as trade single windows. The whole purpose is to streamline, digitize electronic trade documentation, and indeed through electronic means, of course, and to ensure that all of those flows are more and more offering transparency, because those informations will be used for tax reasons, for payment reasons, for lending reasons, and the faster they are handled, the faster the goods can be imported. So there is a cost reduction also on the import side, and we see very strong success stories. Indeed, Morocco, Egypt, and other countries are moving into that direction. It's more a logistics-focused innovation, but logistics is where trade happens. So logistics is where the data and the transactions emerge before we, on the trade finance side, can add lending to those transactions. So the more electronic flows we get from those different platforms, like electronic trade single windows, the better for us on the lending side.
Sure. And to wrap it up, I just have one last question for you before we end this episode. I wanted to ask, if you had to sum it up, what does the future of B2B trade credit look like in the next 5-10 years? And what should platforms, policymakers, and investors be preparing for now?
If we have to summarize this to one word, it's all about transparency. We want to be able to digitize transactions, statements, financial statements, information about due diligence, history of relationships and payment behaviors. Everything over time has to be digital, but when you digitize, you need to be able to verify your transaction data source, and making sure that the policymakers support the market to adopt those new technologies is essential. First step is allowing to use some technologies, like public blockchains, for instance, is one, like artificial intelligence is a second. And then sometimes the regulators need to go one step further, which is to mandate the use of electronic flows for particular critical transactions, so that the market can benefit from increased transparency. So the transparency is really my objective, because it is the enabler for credit underwriters to cover more transactions, for lenders to extend more liquidity, and for businesses to get more working capital. But in order to get to that transparency, sometimes it's not enough to rely on the market to self-develop. We need the market to develop thanks to a regulatory push. And this has happened in payments with open banking, with instant payments, with electronic invoicing. So if we can mandate some of those developments on the payment side, why not mandate also, for instance, the digitization of negotiable instruments, like bills of lading, bills of exchange, prompt notes, and possibly mandate additional trade-related capabilities so that we increase transparency. So a public-private sector partnership is essential here. We have covered a few examples earlier in order to get to that transparency. That's what I'm fighting for, and that's why through ITFA as well, we are very close to policymakers to ensure that whatever we do, we get closer and closer to this higher transparency level, because in the future, I bet what will not be transparent and traceable will become suspicious. If you can't verify data, you need to consider it as suspicious, because with technologies nowadays, we can digitize, we can trace, we can help the consumers verify, the consumers of the data, verify the data. So this transparency and this should lead to an environment where data sources are trustworthy, again, through technologies. So that's what I'm aiming for. And platforms like Vayana are definitely excellent examples of players that are going for this, for delivering this increased transparency on entities and on transactions in order to bring more liquidity to businesses.
André, this has been an incredibly insightful conversation. Thank you so much for agreeing to join us today and for sharing your expertise on the evolving trade credit landscape, of course, the rise of new players and the innovations shaping B2B trade credit. To our listeners, thank you so much for tuning into Voices of Vayana. Stay connected for more such insightful conversations. Thank you.